Everywhere you look right now, the same chart is going viral. Whales dumping billions of dollars, red bars across the screen, and captions screaming that the big players are leaving the market. And for XRP holders, the reaction has been pure panic. After years of waiting for a breakout, the idea that whales are fleeing is terrifying. But here's the kicker: the entire story is being told wrong. That chart everyone is sharing? It doesn't mean what you think it means. In fact, the truth behind these whale moves is much more calculated and much more interesting than just whales selling off. Stick with me, because once you see what's really going on, you'll never look at these charts the same way again. So let's break this down. First, the infamous chart. It shows that wallets holding between 1,000 and 10,000 Bitcoin, or the XRP equivalent, have reduced their balances by over $12 billion in the last 30 days. It looks dramatic. But here's the problem. Most people assume those wallets belong to wealthy individuals. They don't. In reality, the vast majority of those addresses belong to centralized exchanges, custodians, and professional market makers. These aren't hobbyists panic selling. These are the entities that make the market. And their job isn't to hold forever. Their job is to manage liquidity, balance inventory, and profit from volatility. Now here's where it gets fascinating. If you overlay whale wallet data with derivatives open interest, the total amount of leverage in the system, you start to see a clear pattern. When open interest is crowded, whales appear to sell. Shortly after, we get sharp price swings that wipe out over-leveraged traders. Once those traders are liquidated and open interest collapses, whales begin to accumulate again. It's almost like a rhythm. Leverage builds, whales hedge or rebalance, the market shakes out, and then they reload. This isn't random, it's a strategy. Think of it this way. Exchanges and market makers don't want retail traders sitting in massive profit. Why? Because it costs the exchanges money to pay out those wins, and it weakens market structure if everyone is in profit at once. So they use volatility as a weapon. By flushing longs and shorts in cycles, they reset the board, pocket fees, and reload inventory at better prices. It's not personal, it's business. But if you don't understand the game, you become the liquidity they feed on. For XRP specifically, this is even more important. XRP's order books are thinner than Bitcoin's, which means it takes less money to move price and trigger liquidations. That's why you see exaggerated moves on XRP when whales rebalance. It's not that XRP is being abandoned, it's that XRP is easier to use in these liquidity games. And once you know that, you can stop panicking and start reading the signals the way professionals do. So how do you actually do that? Instead of reacting to scary whale charts, focus on 5 key indicators. Open interest. Rising OI with euphoric sentiment means leverage is crowded. That's when to expect a flush. Falling OI after a big move? That's when whales start accumulating again. Funding rates. If traders are paying huge fees just to stay long, it means the market is fragile. Neutral or negative funding often marks quieter accumulation zones. Spot versus perpetual divergence. If perpetual futures dump but spot markets hold steady, it's a derivatives-driven move. If spot leads the selling, then it's real distribution. Exchange net flows. Watch whether assets are flowing into or out of exchanges. Large inflows paired with falling OI might mean staging, not dumping. Outflows with neutral funding can point to accumulation. Short-term holder cost basis. When XRP trades near what short-term holders paid, emotions peak. That's often when the big moves happen, up or down. Now, zoom out. XRP is still holding within its long-term ascending channel. On the weekly chart, it hasn't broken below key support. Moving averages are compressing, which historically leads to explosive moves. And ETF inflows are showing that institutional demand for crypto isn't disappearing, it's shifting. Bitcoin's ETF flows may be slowing, but Ethereum's are surging, and XRP often benefits from that rotation into alts. The big picture remains intact. So the next time you see $12 billion whale dump headlines, ask yourself, who benefits from you panicking? The exchanges. The market makers. The whales who know you'll sell your bags cheap. Once you understand that, the story flips. Instead of being a victim of the cycle, you can use it. You don't chase green candles. You don't panic on red days. You stick to your strategy, whether that's dollar cost averaging, laddering take profits, or holding through the noise. Because the truth is, these so-called whale dumps aren't the end of the market. They're part of the market. They're designed to keep the system liquid, profitable, and reset for the next leg up. If you can stay calm, informed, and disciplined, you won't just survive these cycles, you'll thrive in them. So, what do you think? Do you want me to do a full breakdown next on funding and basis, how to read those rates like a pro, or on spot versus perp divergence, which can reveal whether a move is real or just leverage games? Drop a comment below, smash that like button if you learned something new, and I'll see you in the next video.